Finally, we are joined by Keith Cullen, founder and managing director of WT Financial Group with the ticker code WTL, a company focused on providing the future of quality financial advice. Keith, thank you for joining us.
Yeah, thanks, Jane, and thanks everyone for joining us. And sorry about my preemptive starts, jumping in a bit earlier there.
No worries.
Today I'm going to take you through a little bit of background on the company and our recent acquisition of one of our industry peers, but also more focus on what's happening in the industry generally and the investment opportunity that this presents directly into our company and in the sector generally, and also give you an update on how the integration of that significant acquisition of ours has gone. So WTL started in 2010 and originally under the name of Spring Financial Group, and our focus was in building a direct-to-consumer offering of integrated financial advice, tax and accounting, mortgage broking, and estate planning. In 2018, the board took the decision in the wake of the Royal Commission to pivot and take the intellectual property that we built, the resources that we built, and apply them into the more traditional dealer group space, where rather than having salaried advisors such as we had in the Spring Group, is the advisors in the group are independent business operators operating under the license to which we provide various services. So licensing, of course, being the enabler of their business, we assist them with their compliance and risk management, with their ongoing education, training and technical support, and also practice development in helping them grow their businesses, make their businesses more effective. And the pivot we took was through the acquisition of a dealer group by the name of Wealth Today. And it was at that time that we changed the name of the listed entity to WTL or WT Financial Group. And when we acquired the dealer group initially, we had 40 advisors in it, or 42, I think. We grew that organically to some 120 advisors, and have more recently acquired our industry peer, Sentry. And at the same time as we've been going through that pivot, we've been reducing not only our reliance on the direct-to-consumer market, but also we sold off a number of those assets and restructured our balance sheet. Quickly on the acquisition of Sentry. Sentry itself was established in 2005. So, together both of the businesses have got a long history and a lot of experience within them. And at the time of acquisition had some 155 advisors across 95 advice practices in it. We paid $7 million for Sentry, and depending upon performance over the next 12 months, there'll be upwards of or up to a maximum of a further $3 million payable. It was really a sell-in by the Sentry shareholders, as 50% of the consideration was in stock, and we've retained the managing director of Sentry, I'll talk to a little bit later, and also their chairman joined our board as an independent director. The acquisition has positioned us now, it's been highly complementary, is within the Wealth Today businesses and WTL's businesses. We've put a lot of focus, a lot of emphasis over the last several years in really perfecting both our education and training of advisors, which is becoming imperative with the new education standards in the industry, and also perfecting our risk management framework. You'll hear people in our space talk a lot about compliance. There's a difference between compliance and risk management. They're not the same thing. Yes, we've got a terrific compliance structure in the business, but we really take it the next level and help the advisors identify what risks exist in their business at both a client level and an operational level, and really work with them to manage that. Within the Sentry business, they've done a lot of work in the last couple of years of helping advisors reprice their proposition and make themselves more competitive and more profitable. Bringing these two sets of experiences together has really positioned WTL with a great management team and a great offering for advisors that we consider best of breed. On settling the acquisition, we restructured our balance sheet considerably to give ourselves a clear runway for FY 2021, and certainly management is targeting a return to dividends. The company had a strong dividend history before deciding to go through this restructure program. We paid out some $7 million in dividends, and that's certainly where we're targeting heading from this financial year and beyond. I won't spend too much time on this one, but just quickly to give the uninitiated the shape of what's happened in the industry in the last couple of years in the wake of the Royal Commission. And this really underscores why we took the decision to move into the dealer group space, because it's where we saw the significant opportunity with the resources and experience that we had. You'll see that the big six that had traditionally dominated the industry in the last 10 to 15 years by buying up a bunch of independent dealer groups to use them as distribution for their products have virtually exited the industry altogether, with the exception of AMP and IOOF. So NAB has gone, CBA has now gone altogether, Westpac has gone, and ANZ has gone from the industry. And you'll see what's happened on the other side. We've seen this emergence of some really strong independents there, with you really being able to throw a blanket over a lot of us in that sort of 3 to 7, 8 bracket there. So this is really back to the future for the industry, with advisors rotating to non-product producing, non-aligned dealer groups that give them the freedom and independence to recommend what's right for their clients. Why would you be investing in an industry when the banks are moving out of it? Well, the reality of it is they've decided, and the consumers have decided, they don't like that vertically integrated model. But at the same time, the demand for advice is growing. We're right on the doorstep of a transfer of $3.5 trillion of wealth from one generation to the next. And so demand from consumers is growing. The demand on advisors to upskill is growing. And this really means they need a strong, focused dealer group to support that transition in their education and the types of services that they're providing to their clients. I won't spend too much time on this, but Michael Harrison has joined our board. Rob Jones has joined an advisory committee within the business, and these were two of the vendors of Sentry that are very experienced operators in financial services, and they've joined myself and Guy Headley and Chris Colesis. And on to the next slide, please, Jane. And from a management perspective, as we've had David Newman, who was one of the largest shareholders and managing director of the Sentry business, join us as joint COO. He joins our Frank Paul. Rickton Jones has joined us as head of finance from Sentry, and he joins Jack Standing, who's our group head of advice. So we've built a very strong board and management team with extensive experience, not just in operating financial services businesses, but also critically in mergers and acquisitions. This will be our last one. You can pick up our FY 2021 annual report. And it will detail our results from last year that included some significant write-downs and charges that we took to ensure that we had a clear runway for this year. These adjustments have given us, put us in a really good position to deliver a strong profit for FY 2022. We're giving revenue guidance of 70 million. You can see the scale that that's brought to the business. That's up from about 13 million last year. And guidance is for greater than $2 million of net profit after tax. We've got carry forward tax losses. So whilst we'll book a statutory tax position, as there'll be no tax to pay for the year. And again, we're setting ourselves up for strong dividend payment. As far as the future is concerned, demand for advice is growing. Advisors need a strong dealer group to support them. Smaller groups are becoming marginalised, and it's the critical part in our business is it's very process driven. So we get to, now that we're strongly into profit, we get to really leverage the expensive overhead in the business, which is the experienced personnel, through making sure we're very process driven. And that means as we grow organically, as these advisors continue to be on the move, $1 of revenue, more and more of it drops to the bottom line. Aside from the organic growth we're seeking, there's definitely merger and acquisition opportunities out there. Again, as smaller players become marginalised, and those of us in the middle group seek to collaborate and make ourselves even more cost effective. So I think we made that inside 10 minutes, Jane.
Wonderful. Thank you for joining us on Broker Briefing. We've actually had a question that you just did answer, but I'm going to ask it anyway. So can you please expand on the potential growth prospects, and will the company mainly focus on organic growth by increasing the revenue per advisor, or are there further acquisitions planned?
Yeah, look, there's three ways for us to grow our profitability, Jane. Is across large numbers of our advisors, we've got good revenue share arrangements with them. So we're focused on helping them grow their businesses. And one of the key differentiators between ourselves and other dealer groups, both listed and unlisted, is just the breadth and depth of experience of actually dealing face to face with clients and growing practices ourselves. So we bring that to the table. Clearly, then looking to cross-sell and upsell other services to the existing network. There's definitely strong organic growth available with advisors being on the move, but that's not to suggest we're not on the lookout for other acquisitions as well.
Wonderful. And I encourage any shareholders to reach out via the contact details on the bottom of the release. But Keith, thank you for joining us.
Thanks so much, Jane, and thanks everyone for joining us.